What are the main factors that move the markets? Well, short term, it's fear and greed. So when you hear companies come out and report record profits and that their earnings are up and that their business is doing great and the environment is good and they're going to continue to make money, well, I think that piques people's greed meter, and people feel like they want to get in on it. On the flip side of it, what drives the market down short term is fear. So when you hear bad news coming out, think about COVID and what happened to the market when we started to hear all of the things that were happening in and around the pandemic, the outbreak of the Ukraine war. All of those things tend to move the market short term. Long term, what moves the market is a healthy economy that trends upward over time, but it doesn't do it in a straight line. It kind of does it in a yo-yo kind of fashion. So what are the benchmarks, and when should you be concerned about the volatility in the markets? So if you're looking at the two different charts, which one would you rather invest in? The one on the left shows an investment that drops by about 20% very, very quickly. The one on, do we have them up yet? I don't see them. Okay. They're coming, yo. So the one on the right is going to show a green chart, and it shows an investment that goes up. Oops, they're flip-flopped. That goes up about 2,600%. So the one on the left in green has a gain of 2,600%. The one on the right drops by 20%. Well, it's kind of a no-brainer. Which one would you pick, obviously? And it really is a trick question, because guess what? Both charts are the same investment. They just have different vantage points. They're both the S&P 500. They're both the market. So the one on the right in red, the 20% drop happened in less than 2 months during 2022. The one on the left in green, it had a 2,600% gain. Yes, not 26%, 2,600 happened over 40 years. So, lots of you were maybe invested during the 2007, 2008 time period. And if you were, most people really remember that, because the S&P 500, and if you're looking at that chart on the screen, it's just really a blip. You can't even really hardly tell where it was unless you look at the years along the bottom. But it was a 53% drop in 17 months from October of 2007 through March of 2009. So did it really matter? What if you invested in December of 2007, right before the market dropped by about 53%? Well, it only mattered if your vantage point is from March of 2009, when you were down 53%. And that is if you were 100% in the market. So if your vantage point is from today, looking back, and you invested at the high of the market right before a 50% 17-month drop, and you stayed in, you're up over 260%. So, that really helps us to put it in perspective. I know that we live in a short-term world. We hear what's happening in the news every day. You just heard us talk about how the NASDAQ dropped over 2% yesterday, and it almost seems like the sky may be starting to fall when you hear those kind of things. But when you really step back and put things in the proper perspective, that's why you hear us talk about long-term all the time. It's hard to think long-term in a short-term world, but we do our best to help you try to remember to do that.